What are derivatives? Derivatives is an asset class that is always discussed very controversially by the media, especially in times of crisis. And derivatives are actually one of the most complex investment products in the finance world. The term derivatives comes from Latin and means nothing other than derivation. This explains very well what a derivative is. It is a financial product that is derived from another financial product, the so-called underlying asset. This underlying asset can be other securities such as shares or bonds, but also much more abstract indicators such as indices, interest rates, or price developments. Derivatives have no intrinsic value of their own. They have their origin in another financial product and profit from its rise or fall. Derivative is a generic term for a huge investment universe. There are now over 1 million derivatives. These include, for example, reserve convertibles, options, CFDs, swaps, or futures. Most derivatives are traded OTC, which means over the counter. However, many derivatives can also be traded on a trading exchange, the so-called exchange-traded derivative. Derivatives are both used for hedging and speculation. So are they now the devil's work or a blessing for the economy? Let's postpone that question for now and look at how derivatives work. Let's say you bought a derivative on the price of oil. Imagine you are a driver and have been annoyed by the rising price of gasoline. Now you want to profit from the rising oil price. Let's assume that Brent oil, which is the unit of measure for oil on the stock exchange, is currently at $100. You have bought your derivative for $10 and it represents 1-to-1 the Brent oil price. If the oil price now rises from $100 to $111, your derivative will also rise from $10 to $11, exactly 10%. If you want to profit more from the development of the oil price, you can buy a derivative, which does not replicate the oil price 1-to-1 but 1 to 10. In this case, your derivative will rise 10 times faster than the underlying asset. Your derivative is then no longer worth $11 but $20. Of course, you also have a higher risk because you can lose much faster. As you can see, with derivatives you can bet on the price developments without having to buy the underlying asset. In this case, Brent oil. You bet on a rising oil price while someone else believes that the oil price will fall and bets against you. Instead of hedging, you also can use derivatives to hedge risk. In technical jargon, this is called hedging. Let's say a wheat farmer wants to hedge against the risk of fluctuations in the price of wheat. He wants to do this before he harvests his crop, let's say 9 months in advance. He wants to know today that he will be able to sell a ton of wheat in 9 months' time for, say, $200. In this case, he can buy a derivative such as future, which gives him the right to sell the wheat at $200 in 9 months. His counterparty can be, for example, a cookie factory which also wants to hedge against price fluctuations, in this case against increases in the price of wheat. Both parties therefore have a price certainty 9 months before the sale. This price does not change anymore. If the price of wheat now falls on the stock exchange, the farmer has made a good deal. If we assume that the wheat price of the stock exchange is now at $140, he can sell it for $60 more expensive because he had concluded the contract at $200. However, if the wheat price rises to $240, the cookie factory has made a good deal, as it can buy it for $200 instead of $240 a ton. Many companies do such hedging, especially in commodities such as currency, where hedging is very common. At the beginning I said that derivative is a generic term for a whole investment universe. So let's take a look at what categories we can divide derivatives into. There are unconditional derivatives and conditional derivatives. In both examples, oil price and wheat price, we had unconditional derivatives. The derivatives are executed without condition. The wheat farmer must sell for $200 per ton and the cookie factory must buy for $200. Unconditional derivatives include, for example, futures, forwards, or swaps. Our example with the wheat farmer would look completely different if the farmer had chosen a conditional derivative. Let us take the example of an option. He could have bought an option that gives him the right to sell for $200 per ton, but not the obligation. If the exchange price is now below $200 per ton, for example at 100, then he will use the right and sell for $200. However, if the exchange price is above $200, for example 300, he will let the option expire and prefer to sell on the stock exchange for 300, then to fulfill his option. To have this option with a right but no obligation, he must pay a so-called option premium. I can imagine that the whole thing sounds very complicated. But that's not particularly surprising, since derivatives are pretty much the most complex thing the financial world has to offer. Therefore, don't get confused. Now that we know how derivatives work and what forms they take, we still need to come back to the question of whether derivatives are the devil's work, a pure speculative tool, or it can actually be useful for the economy. In my opinion, you can compare derivatives with a knife. If you have a knife in the kitchen to cut vegetables or use it for eating, it is very useful. But you can also use a knife as a murder weapon. The same is true for derivatives. On the other hand, the global derivative market has now swelled to 600 trillion. That's about 10 times the gross national product of the entire world. So there are significantly more hedging or betting than actual trades are being made. This is of course a very clear indicator that there are far more speculators on the market than people who are actually want to hedge the risk. In principle, speculators are not a bad thing in the first place, because they provide liquidity in the market and help companies to transfer risk. But base prices are artificially driven up. In the past, various banks have been accused of speculating on food prices, such as corn or wheat. This then drove up prices so that people in third world countries could no longer afford to buy these commodities and famine ensued. If this is your first time on our channel, we would be happy if you subscribe to us. We regularly produce new videos about investments, finance and economics. We want to help you with finances in order to be able to make decisions independently of advisors. We upload new videos every week, so subscribe to us to stay up to date.